Hello traders, and welcome to our next video on equities and indices. So what are they then? So basically, equities are publicly listed companies on a regulated stock exchange. A regulated stock exchange basically means one central place where all data goes through so that you don't get data discrepancy and price discrepancies between different brokers. So why does a company give out its equities and indices? Because it's just a different way. It's a mechanism for them to gain capital from investors by giving a slice of their company. And that is what we actually then call shares, right? That's when you say you're buying shares within a company. So it's a share, a slice of the company. And why does the company do that? To raise the capital, so that then they can reinvest it to making more profits. And of course, and how do the investors make money out of it? Of course, if they buy and then sell the shares at a higher price. Okay, so some examples of some stocks, as you may have known or you may get used to already, is Google, Amazon, the big blue chip companies, right? Barclays, right? So those are all different types of examples. Now we move on to the next type of market, which is correlating with the equities, is the indices market. Now you must understand the indices market is basically a section of the stock market. That's what I've done over here. A section of the equities, or you can call it stock market, okay, either term interchangeably. Now the indices, since it's a section of the stock market, so for example in the FTSE 100, you got 100 stocks, right? So it's taking all those prices and cumulatively putting it into one chart. So it's a section. And how do they do it? How do they put that price then? So basically is what we call a weighted average, okay? So that's how they compute the prices and make it into a weighted average. It's a formula. You can go and search the formula as well. It's all publicly available. And through that weighted average, then you get the different indices showing as different prices, but cumulatively of all the whole markets in general. So in terms of that, you get different types of indices. You get the FTSE, and also known as the UK 100. Okay, the FTSE, there's different types as well. So this UK 100 basically means the top 100 companies, okay, in London through the London Stock Exchange in UK. Now, for example, the US has got one of the common ones is the US 30, the Dow Jones 30, and like that, there's so many different types of indices. Okay, so that's all to do in this topic here on what is the equities and indices market. Now, let's look at the market size and liquidity of the equities and indices market. So I've just given you two examples over here. Now the first one is we wanted to take a look at the London Stock Exchange, okay? So what is the market size of the London Stock Exchange? As a market cap of $2.05 trillion, right? A trillion is like 1,000 billion. And also an average daily turnover of $2 billion, all right? The next one, what we are then looking at is the New York Stock Exchange, okay? So this is where all the New York stocks are fed through, all the price data of all the US stocks are fed through. And that is a market cap of $19.6 trillion. That's so much more bigger than the London Stock Exchange, like almost 10 times. And that's an average daily turnover of 43 billion every day. That's the amount of money that goes through the New York Stock Exchange. These are all just some examples. You can take a look at all the other exchanges around the world as well. We just wanted to point out these two main ones to you and how you can actually look at them as well. So now we're going to be looking at price increments. Okay, now in normal everyday transactions, whenever you make a transaction to buy a book or a laptop, you may have asked yourself, what's the smallest price increment that product can increase by? So for example, when you buy a book, let's say it's £50, 55 pence, the smallest price increment that it can move by is only 0.01. And that, in other words, in the UK, we call that a penny, right? For example, in the US, you may call that cents. And in other countries, according to the currency that they are trading in. So penny, it's like, so basically it's 2 decimal points, 0.01. In the stock market, in the equities or the indices market traders, the smallest price increment, just as this, is what we call points, okay? And as you can see over here, you can see the bar, vertical bar charts that we have shown over here, which we're talking about much more in detail later on in our sub-modules. As you can see, as those bars fluctuate, the smallest increment that they can have is just 0.01, and that is what we call a point. Okay, I believe you have understood very well on this videos on what is the equities indices market, the market size and liquidity, and also the smallest price increment. Now let's move on to the next type of market, which is the foreign exchange market. We trust you enjoyed our Traders Education Center tech video. To unlock the full tech modules for free, click on the link below and hit the subscribe button. Then go ahead to register with your contact details and create your unique username and password to enjoy the fully unlocked tech modules.